Hi, everybody. This is Friday, January 14th, 2011. Well, the week has come to an end. And, once again, it seems like everybody is convinced that the U.S. economy is indeed recovering, despite the fact that the only real evidence of a recovery has to do with consumers spending money, government spending money, higher retail sales, higher GDP numbers that result from increased spending. But spending borrowed money, as I said many times, does not indicate that the economy is recovering. I mean, look at the anemic job numbers. Last week we got far fewer non-farm factory payrolls were created. Yesterday we found out that during the first week of 2011, we had 440,000 people filing first-time unemployment benefits. That was a 30,000 claim jump on the prior week, much more than had been anticipated. 2010 was a record year for foreclosures, and that's despite the fact that we had a huge drop-off in foreclosures late in 2010 as a result of that robo-signing scandal and the moratoriums that many of the banks placed on foreclosures. It would have been a much bigger record had it not been for that. Thinking about the U.S. economy recovering, the only reason that it appears that we're recovering is that we're spending. And the only reason we keep spending is, one, because we keep borrowing, and two, because interest rates are still very, very low. Even though they've risen somewhat over the long term, the Fed still has interest rates anchored at zero. So in other words, the economy is on artificial life support. Think about it this way. What if you checked into a hospital for an operation, and then the following morning you woke up and you asked the doctor how you were, and the doctor said, well, you're recovering very well. And you look around and you notice that you're hooked up to all sorts of machines. There's a machine that's running your heart. There's another machine that's running your lungs. You're eating intravenously through tubes. And then you ask the doctor, doc, what happens if you disconnect all these machines and pull all these plugs? And the doctor says, oh, but then you'll die. Well, I wouldn't exactly get excited about a recovery that was dependent on being, connected to all these artificial life support. Well, the U.S. economy is on artificial life support right now. And it's my feeling that the plugs are going to start to be pulled, particularly by the Asian economies that are sustaining these low rates. I mean, we are getting all this information about inflation. Now, today, in the U.S., we got our CPI. And for all of 2010, according to the government, consumer prices were only up by 1.5% for the whole year. And the core rate, which of course is meaningless, but the government puts more emphasis on that, was up 0.8%, which I think was the smallest annual increase since 1958, I guess, when they began keeping track of these statistics. But if you look beneath the surface, if you take the second half of 2010 and annualize the rates there, CPI was increasing at a 3% rate. So clearly inflation is getting worse. I believe that even the government CPI for all of 2011 will come up with an annual increase well north of 3%. But meanwhile, the rest of the world, particularly in Asia, they have inflation rates north of 5% and higher, and particularly when you're looking at food prices, which are not, right now, food prices are at a record high. The United Nations is warning about food riots, but food prices are increasing by better than a 10% annual rate. Now, it makes no sense that the countries that have stronger currencies than ours, that have higher interest rates, that are producing all the stuff that we consume, that they would have higher inflation than we do. So part of it has to do with the integrity of the numbers, but a lot of it has to do with all of the money that is being created outside the United States. For example, China announced the other day that they are increasing their reserve requirements. So they're trying to tighten monetary conditions. But meanwhile, they also announced that in the fourth quarter of 2010, their foreign exchange reserves grew by $200 billion. That was a record. Their FX reserves now are almost $3 trillion. They're about $2.8 trillion. And at the rate they're adding to their reserves, pretty soon, China will be adding $1 trillion worth of reserves per year. Now, obviously, they're not going to do that. But how can they control their inflation when their money supply is exploding? A lot of people are trying to blame higher commodity prices on the weather. They do that all the time. Remember the Soviet Union? Every year they blamed their problems on a drought. It was a drought every year. It's not the weather. Yes, there are problems with the weather. That happens all the time. But it isn't a coincidence that food prices are soaring when money supplies are soaring. That is what you'd expect to happen. But so the Chinese are having a political problem right now with inflation. And it's going to get worse. There will be instability if they don't get a handle on inflation. And the only way they can do that, as I've said many times on this blog, is to stop inflating, to stop increasing their foreign exchange reserves, to stop buying dollars, and to stop buying treasuries. And so when they stop importing inflation for us, we're going to be stuck with our own inflation and have to eat the rising cost of living ourselves instead of putting it off on the Chinese. And in fact, if you look at what happened in the commodity markets this week, the CRB continued to rise. Oil prices closed again at a new high for the week. They closed above $92 a barrel. Now, we did have a pullback in gold and silver this week, but I think that has to do not only with tightening coming out of China and the perception of what that might do to the metals market, but I think more important is what's happened with the euro this week. This week, we saw a real surge in the value of the euro against all currencies. And in fact, the dollar index dropped back down to 79 based on the high weighting of the euro. Now, there are a lot of people who have put on a trade where they are long gold and short the euro. So they're long gold in euro terms. They're using gold to hedge weakness in the euro. And I think what happened in the last couple of days is many of the people who had that trade on have decided to cover up those positions. And so what they have to do is they buy back the euros and they sell gold. And I think that's why you're getting a lot of pressure on gold, because you're unwinding some of the bets that were made against the euro in gold. But ultimately, if in fact the euro has turned against the dollar, and so now not only is the dollar going to weaken against the Swiss franc or the Aussie dollar, but it's going to weaken against the euro, right? And I still think the euro will be weak, but now the euro maybe will be less weak than the dollar. And so we will be in a situation where we have a generally declining dollar. And I think that situation, that environment, is far more bullish for gold than the environment we've been in recently, where all currencies have been weak, but the dollar has not been as weak as the euro. And so I think that while the short-term movements are producing a correction in both gold and silver, I think the resumption of a general decline in the dollar is very bullish for gold and silver, which is why I think both gold and silver should be bought. But it is also interesting, and it confirms this thesis, that in general, other commodities were much stronger on the week. Take a look at copper. I mean, copper is a metal, but it didn't go down. Copper continued to rise. So I think this is a currency unwinding, a monetary bet, not a commodity bet, but a bull market for commodities, more inflation. This is a good environment for gold and silver. So I don't think this correction will last much longer. And I think it is a real opportunity for people who are looking for an entry point to get in. And of course, I continue to hear warnings from the financial community. Look out below. It's a bubble. The bubble is going to burst. I think it is far from a bubble. In fact, it's the antithesis of a bubble. If anything, the bubble is still in the dollar. And when that bubble bursts, and when the bond bubble bursts, I expect gold and silver prices to rise. And so in short, the artificial life support that's coming from these low interest rates, as the Chinese realize that the only way to combat their inflation is to allow a more rapid appreciation of their currency, and they stop buying our debt, you will see upward pressure on interest rates. And as consumer prices rise, and as you see the trends of 2010 exacerbating in 2011, and the CPI, despite the government's best effort to disguise the inflation, really starts to show up in a big way, that's going to put a lot of pressure on the Fed. And if the Fed does not raise rates, as I believe it won't, it will lose whatever credibility it has left. And then you will really start to see a decline in the dollar and a corresponding increase in long-term interest rates. Anyway, that's it for today. Take care, everybody, and enjoy your holiday weekend, and have a good Monday, Martin Luther King Day, and the markets will be closed. So take care, everybody. That's it for now.